Hi guys, welcome to my YouTube channel. In this video, today we will talk about managing risk in investment portfolios. What is risk? Risk is defined in financial terms as the chance that an outcome or investment's actual gains will differ from an expected outcome or return. Risk includes the possibility of losing some or all of an original investment. Quantifiably, risk is usually assessed by considering historical behaviors and outcomes. In finance, standard deviation is a common metric associated with risk. Standard deviation provides a measure of the volatility of asset prices in comparison to their historical averages in a given time frame. The basics of risk. Everyone is exposed to some type of risk every day, whether it's from driving, walking down the street, investing, capital planning, or something else. An investor's personality, lifestyle, and age are some of the top factors to consider for individual investment management and risk purposes. Each investor has a unique risk profile that determines their willingness and ability to withstand risk. In general, as investment risks rise, investors expect higher returns to compensate for taking those risks. A fundamental idea in finance is the relationship between risk and return. The greater the amount of risk an investor is willing to take, the greater the potential return. Risks can come in various ways, and investors need to be compensated for taking on additional risk. For example, a U.S. Treasury bond is considered one of the safest investments, and when compared to a corporate bond, provides a lower rate of return. A corporation is much more likely to go bankrupt than the U.S. government. Riskless securities. While it is true that no investment is fully free of all possible risks, certain securities have so little practical risk that they are considered risk-free or riskless. Riskless securities often form a baseline for analyzing and measuring risk. These types of investments offer an expected rate of return with very little or no risk. Oftentimes, all types of investors will look to these securities for preserving emergency savings or for holding assets that need to be immediately accessible. Examples of riskless investments in securities include certificates of deposits, CDs, government money market accounts, and U.S. Treasury bills. The 30-day U.S. Treasury bill is generally viewed as the baseline, risk-free security for financial modeling. It is backed by the full faith and credit of the U.S. government, and given its relatively short maturity date, has minimal interest rate exposure. Risk and time horizons. Time horizon and liquidity of investments is often a key factor influencing risk assessment and risk management. If an investor needs funds to be immediately accessible, they are less likely to invest in high-risk investments or investments that cannot be immediately liquidated, and more likely to place their money in riskless securities. Time horizons will also be an important factor for individual investment portfolios. Younger investors with longer time horizons to retirement may be willing to invest in higher risk investments with higher potential returns. Types of financial risk. Every saving and investment action involves different risks and returns. In general, financial theory classifies investment risks affecting asset values into two categories: systematic risk and unsystematic risk. Broadly speaking, investors are exposed to both systematic and unsystematic risks. Systematic risks, also known as market risks, are risks that can affect an entire economic market overall or a large percentage of the total market. Market risk is the risk of losing investments due to factors, such as political risk and macroeconomic risk, that affect the performance of the overall market. Market risk cannot be easily mitigated through portfolio diversification. Other common types of systematic risk can include interest rate risk, inflation risk, currency risk, liquidity risk, country risk, and sociopolitical risk. Unsystematic risk, also known as specific risk or idiosyncratic risk, is a category of risk that only affects an industry or a particular company. Unsystematic risk is the risk of losing an investment due to a company or industry-specific hazard. Business risk. Business risk refers to the basic viability of a business, the question of whether a company will be able to make sufficient sales and generate sufficient revenues to cover its operational expenses and turn a profit. While financial risk is concerned with the costs of financing, business risk is concerned with all the other expenses a business must cover to remain operational and functioning. These expenses include salaries, production costs, facility rent, office, and administrative expenses. The level of a company's business risk is influenced by factors such as the cost of goods, profit margins, competition, and the overall level of demand for the products or services that it sells. Operational risk is a type of business risk that arises from the day-to-day operation of a business and can include risks associated with system failures, human errors, fraud, or other internal processes that might negatively impact a business's financial performance. Operational risks can be managed through effective internal controls, processes, and systems. Businesses and investments can also be exposed to legal risks stemming from changes in laws, regulations, or legal disputes. Legal and regulatory risks can be managed through compliance programs, monitoring changes in regulations, and seeking legal advice as needed. Credit or default risk. Credit risk is the risk that a borrower will be unable to pay the contractual interest or principal on its debt obligations. This type of risk is particularly concerning to investors who hold bonds in their portfolios. Government bonds, especially those issued by the federal government, have the least amount of default risk and, as such, the lowest returns. Corporate bonds, on the other hand, tend to have the highest amount of default risk, but also higher interest rates. Risk versus reward. The risk-return trade-off is the balance between the desire for the lowest possible risk and the highest possible returns. In general, low levels of risk are associated with low potential returns, and high levels of risk are associated with high potential returns. Each investor must decide how much risk they're willing and able to accept for a desired return. This will be based on factors such as age, income, investment goals, liquidity needs, time horizon, and personality. Risk and diversification. The most basic and effective strategy for minimizing risk is diversification. Diversification is based heavily on the concepts of correlation and risk. A well-diversified portfolio will consist of different types of securities from diverse industries that have varying degrees of risk and correlation with each other's returns. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.